Hello, Business 330 students. This is Professor Hassey. It's our week 2 class lecture in regard about our study and topics for week number 2 of our online Business 330 course for the week of June 14th through June 20th. Our topic this week is financial statements, but also our topic this week is making sure you post and have properly submitted your financial portfolios of your stocks that you have selected. Some of you still have some corrections to make and resubmissions. Make sure you go to the discussion forum and look at my notes. If you don't see a grade for your work for that portfolio in your grade center, that means you have to resubmit and correct something. So make sure you do that and fix that this week. Also, some of us still need to schedule our professor meetings for next week, the week of June 21st. There's a schedule in the discussion forum. Please do so. Remember, this is a graded task for our course that you meet with me to just review the course and make sure you have, if you have, answer any questions or concerns you have about the class. So make sure you sign up for that. Look for the schedule in your discussion forum. A couple things to note in our Blackboard as we begin and review our study for this week, number 2. Remember, you should be pretty familiar with our Blackboard file folder now. Our Zoom and YouTube links file folder has the lectures and the links to our student hours on Tuesday evenings. There's our lecture from last week. Our introduction videos are in every week. So here's week 2, and there's our introduction video to the topics of this week and relevant material. This is the spreadsheet we're going to work on in our lecture, this video recording. Week 2 in-class review, we're going to look at the financial statements of a real company and look at them. Here's the site to make sure you sign up for your professor meetings. Here are the students that have signed up this point on Thursday afternoon. And if you're not on this list and you do not see it, make sure you sign up for our professor meeting next week, Monday through Thursday. And then back to week number 1, the discussion forum of posting your portfolio and your bio. Most of you have done the bio portion, but some of you still have yet to submit your final adjusted portfolio and get out any kinks or issues with that I have submitted to you. So make sure you do that as well. So going to week 2 this week, financial statement and analysis. First off, right off the bat, if you go to the bottom of the file folder, there are some problems and reviews from the first 2 chapters, our discussion of last week. If you'd like to look those over as review, they're not required for the course. I just put them there as a helpful hint, those review problems, and I will post the solutions to that file folder immediately after this lecture. But they're review problems, and you might want to look them over if you so desire out of those pages in chapters 1 and 2. There's some videos of our topic this week, financial statement and analysis. Some very good videos of that. Some review of our chapters 3 and 4, the PowerPoints associated with them, the definition of the Dow Jones Industrial Index, which is part of your portfolio, what makes up that index, and a good thing to know what's going on there. Last week, we had the S&P 500. All right, so that leads us to our topic this week. Financial statements and analysis. And let me bring up our financial statement that we'll be looking at in this lecture. One of the prerequisites of taking this 330 class is you've had to take some accounting, and at least one accounting class, preferably 201, but most of you have taken 201 and 202. Remember, accounting is a record of business transactions, and then telling the world and your company employees and management how you're doing. So the priorities of financials in finance is to do 2 things. Provide a historical review of the company. Are we maximizing value? Are we doing what we're telling our investors we're doing? Are we making enough money to pay interest on our debt and pay back the debt? Are we making enough money in cash flow to pay dividends, to increase the value of the business? That's number 1, a historical review. What happened? Number 2, provide data for future planning and financial management. With this information, this is going to determine the strategies of our company in the future. If we have very little debt and a lot of cash flow, we can invest this cash flow in new products, new markets, buy up other companies. But if we have minimum amount of cash flow and a lot of debt, that limits the amount of growth that we can do and how we survive in the marketplace with our competition. So the financial statements provide two bits of information for the strategy and planning of our company: historical review and data for that future planning in financial management. And remember the three financial statements: the balance sheet, a statement of financial position on a given date; the income statement, the statement of revenues and expenses for a period of time; and the cash flow statement, a statement of cash coming in and going out of our business during a particular period of time. These three statements tell us what's our historical perspective of our company. That's what chapter 3 is about. And then chapter 4 is taking these three financial statements and doing some statement analysis. There's a particular page in your textbook, pages 104 and 105, that show this in one lump sum, one page of analysis of what all these are and what they mean to determining the analysis of your company. Investors, competitors, the government, regulators, your employees, management, your board, all look at these financial statement analysis to determine the various efficiencies of your organization. We need to know a few of these for our assignment next week, in assignment number 1. Remember, we have an assignment next week that's due Sunday, June 27th. It'll be posted on Monday, June 21st. And that assignment will encompass chapters 1 through 4. It'll be a combination of multiple choice, fill in the blank, and some work problems. And one work problem will be to review a financial statement and find these key things. Also, one problem will be to select one company from your portfolio and tell me certain things about the financial statements of that company in the real world. So you'll need to be going to the internet and looking for those financial statements of your company. So that's our assignment coming up, and this all leads into that work next week. So let's talk about the financials of a company. Remember, the balance sheet is a statement of what we own, assets, what we owe, and the ownership of the business, liabilities and equity. And notice they are always in balance. It's a statement of financial position. On December 31st, 2020, this company had $3.5 million of assets. They had $1.5 million of debt, and they had $1.98 million of ownership or equity. Liabilities or debt are made up of short-term non-interest bearing liabilities, which are called current liabilities, and long-term liabilities like bonds or mortgages that are interest bearing. Equities are made up of common stock, the book value of the stock issued by the company in the marketplace, and the retained earnings of the company. It's accumulation of profits the company has retained over the life of the organization. That combination is the balance sheet. The income statement is just simply for a period of time, the year ending December 31st, 2020, what our revenues were, what our expenses were, what our operating earnings were, what our interest expenses were, and what our taxes were. That all sums up to net income, or in the case of 2019 in this company, their net loss. That's the income statement of the business. And the cash flow statement is where did the money come from? What cash came in? What cash went out for a year ending December 31st, 2020? And it's in three particular areas of the company: operations, financing, and investing. The combination of that is our total gain or loss of cash during the course of the year. If we look at the balance sheet again, look at the balance sheet. There's a cash position of $7,282 in 2019 and $14,000 in 2020. They don't have much cash. If we take the delta of those two, the difference between 2020 and 2019, we get $6,718. That should be the statement of cash flow change. If we go to the cash flow statement, we'll see. There it is right there. $6,718. They had $170,536 of cash going out, that's negative, from operations. They had $245,936 of cash coming in from financing, and they had $66,682 going out of investing. The combination of those three gives us $6,718, which happens to be the delta or the change in our cash account for the year. Investors want to see where the cash flow is coming from. Profits, depreciation, cash going out because we're not collecting receivables, cash going out for inventory, cash coming in for the borrowing of money, cash going out for the payment of debt, cash going out for the payment of debt, cash coming in for the issuance of common stock, cash going out for dividends, cash going out for the purpose of investing in short-term investments, and cash going out to purchase fixed or plant assets. The combination of all those is that. And all this information is in the first two financial statements, the balance sheet and the income statement. You need to refresh your memory on these for chapter 3. What do these three statements tell you, and how do you interpret them? That's what you need to study for this chapter 3. Some other information about this company. Their year-end stock price was $12.17 a share. Their outstanding shares at the end of 2020 were $250,000 shares, excuse me. They started out with 100,000. That means they issued 150,000 more shares of stock. And you can see that down here in common stock. Note the delta from 2020 to 2019. An additional $1.22 million increase in common stock because they issued 150,000 more shares of stock. And there's that money sitting in the cash flow statement under financing. That's cash coming in for the issuance of common stock. All these cash flow statements, items, come from these deltas in the financials. Profits, 253,584. There they are right there. Depreciation, 120,000. There it is right there. Wait a minute, Mr. Hassey. Depreciation is cash flow? Sure is. We're expensing depreciation, doing a journal entry to adjust the accounts, but are we writing any checks to Mr. or Mrs. Depreciation? No. We're expensing money without paying money. We're allowed to do that by our tax codes and our accounting regulations. So we add that depreciation back in as cash flow because it's a non-cash expense. It's an important concept. So that's the information coming from the income statement. Also, notice we paid out 22 cents a share in dividends in 2020. We had 250,000 shares of stock to pay that 22 cents a share dividend. If I take 22 cents and multiply it times the 250,000 shares of stock, I get $55,000 in dividends. And in our cash flow statement, that's how much we paid out in dividends to our shareholders of cash going out in 2020. Now that we have these two bits of information, net income and dividends, we now know how much money, additional money, was added to retained earnings. Remember when we close the books of a company from your accounting days? You close out all revenue and expense and dividend accounts to retained earnings. What's the difference between net income, 253, 584, and the difference between that and dividends? $198,584. Our company increased in equity $198,584. And if you take the delta between 2020 and 2019 in retained earnings, there it is right there. Retained earnings increased by 198,584. So they've properly closed their books and increased the equity position of the company by the difference of profits less dividends to their investors. That's how all that works. And also, you take the deltas amongst all these accounts. Short-term investments, 51,632. There it is right there, 51,632. Investments went up. That means we paid cash to acquire those. That's why here it's negative cash. Accounts receivable increased to 45,840. That's why we subtract it here in operations, because that's money we did not collect. It still owed us. So we have a negative cash position in receivables because we sold more in invoices and we didn't collect them. Cash is held up. Same thing holds true with inventory. Inventory increased 429, 120. That's inventory that we purchased that we have yet to sell. That's a negative cash flow on inventory. Look at accounts payable. Accounts payable increased by $35,800. We owe more money. But because we owe more money, that means we have yet to pay it out in cash. So we basically save cash by owing that money. Now, eventually we're going to have to pay that back, but at the end of December, it's considered positive cash flow. Look at accruals. 95,040. The same thing. Remember, accruals are other types of liabilities we owe, like sales taxes, payroll taxes, property taxes. We're going to have to pay them eventually, but we didn't pay them in 2020, so it's considered positive cash flow. All these accounts here, receivables, inventory, accounts payable, and accruals, are all considered current working capital. That's why they're in current assets and current liabilities. They're considered operating assets, operating liabilities. You need those accounts to run the day-to-day part of your business. Another item here was notes payable. It's sitting in current liabilities because that's telling the reader of this financial statement that this money is due within the next 12 months. But remember, by it saying notes payable, that's an interest-bearing loan. So it's part of not operations, it's part of financing. And here's that minus $420,000 we paid down during the year, negative cash flow, because why? It was reduced from 720 to 300,000 in year 2020. That's cash going out to pay that liability. But it's considered a financing financing cash flow because it's interest bearing. It's just due within the next 12 months. Look at these other assets. Our long-term assets, gross fixed assets or plant and equipment, increased by $17,050. That means we purchased $17,050 more of additional assets. Thus, under investing, That's $17,050 going out. We purchased additional assets. We invested in ourselves. Depreciation was 120,000, just like it is right here on our income statement. That's why depreciation is right here as positive cash flow in operations. And finally, we have our long-term liabilities. Long-term bonds had a delta. We paid off $500,000 of those bonds. Thus, $500,000 is cash going out for the payment of the long-term bond. And then finally, under short-term investments, we see we paid out 51,632, as I said earlier. That's investing money going out. So now we found all these balances in our financials, and it comes to what our cash changed during the course of the year. So that's how all the financial statements for this company, Reggie Dunlop Incorporated, for 2019 and 2020 work. They tell the world that we're in balance. They tell the world that we made a profit. They tell the world what our liabilities and equities are. They tell the world what's our cash flow and our cash management. And from these, the world now takes and does statement analysis. They take a look at the liquidity of the company, the debt management, profitability, market value, efficiency. They take a look at all these as information from these financial statements. Chapter 4 is about those measurements of financial analysis that you need to be aware of. This is where the world gets to know your company by comparing past performance in ratios or percentages and comparing those to your competition, to the industry. These are key areas where companies can interact with their performance to other companies. Very important. And on page 104 and 105 of your textbook is this interpreting financial ratio page that defines all these main financial analytical information: performance, profitability, efficiency, leverage, liquidity, all ways of determining the efficiency and the quality of the company's financial performance. You need to know a few of these, and they're all defined and shown in chapter 4. And here are the ones you need to concentrate on. These are the ones on the third tab in our spreadsheet for this week that you need to know about: current ratio, debt ratio, profit margin on sales, return on total assets, price earnings ratio, earnings per share, and average collection period. There's a whole list of them, about 15 or 20 in the chapter, but you just need to know these 7 for further study, for further work in this course, and for further work in future courses that you'll be taking. And the definitions and how to calculate those are in chapter 4, but I'm going to do 2019 here, and then you can maybe go and practice and try to find 2020. Here is the industry averages for this company in their industry, what their competitors are at these levels. So the current ratio, the definition of current ratio is current assets divided by current liabilities. All right, so if I go to 2019 to the balance sheet, current assets, there they are right there, divided by current liabilities, right there. And I get 1.46. Current assets divided by current liabilities. 1.46. In other words, there's 1.46 current assets compared to $1 of current liabilities. That's pretty good. The industry average is about 1.25. That's very good. It should be around that. Shouldn't be any higher than that. That means you have a lot of receivables or inventory. Should be about that. Now, this company has a lot of receivables and inventory and not much cash. That's not good. But it's a combination of those are what we're looking at. The debt ratio, which is total debt of the company divided by total assets. Total debt divided by total assets. That's the debt ratio. It's a percentage. So I go to my balance sheet, total debt, there it is right there, and divided by total assets. 80.68%. Pretty high. The industry average is 60%. What is it in 2020? See if you can calculate that. It goes down because remember, they're paid off a lot of debt in that month. The profit margin on sales is the net income divided by the sales of the company or the revenue. Net income divided by revenue. It's a percentage of sales that are profits. So we go to the income statement here. Net income, remember it was a loss, divided by sales. So we had a negative 1.63% profit margin in 2019. That becomes positive in 2020, which is a good thing. The profit margin, the relationship of net income to sales. Return on total assets is net income divided by total assets. The relationship of profits to the asset base of the company. In 2019, that would be net income divided by the assets of the company, negative 3.3%. Not very good. We're returning negative numbers. This tells us for every invested asset, how much of profit is that generating? Well, in 2019, it was negative, not good. I'm going to skip down to the earnings per share to do this first. The earnings per share is the net income divided by the outstanding shares of stock. Net income divided by the outstanding shares of stock. So the earnings per share in 2019 was our net income, negative, divided by the number of shares of stock outstanding. Here they are right here, 100,000, negative 95 cents a share. This is another way of showing net income that's a little bit easier. A lot of companies do this in their financial reporting. You see this on CNBC. You see this in the Wall Street Journal. They don't say, oh, our net income was negative $95,000 in 2019. Our net income was negative 95 cents a share. It puts it in relationship to compare it to prior years. What was our earnings per share in 2018, 2017? It gives us some idea of trend analysis. Then we do the price earnings ratio, which is the stock price at the end of that period of time divided by the earnings per share. This is a marketability number. So equals, what is our stock price at the end of December 2019? It was $6. Divide that by our earnings per share, and we get 0.631. The relationship of the stock price to the earnings per share. That's not good either because it's negative. You want to have a positive. Notice the industry average is 10. In other words, the stock price is 10 times greater than the earnings per share. In investing, that's an important number. The higher this number, the stock is considered overvalued. In other words, the market price is way higher than what it should be for generating that type of net income. Tesla is an example of a high price earnings ratio. We'll talk more about that in another week. But that's the price earnings ratio. It's a marketability number. And then the average collection period. This tells us how long does it take us to collect our receivables. That's an important number for cash collections. So this collection period is this formula. It's the receivables or the accounts receivable balance at the beginning of that fiscal year divided by the average day sales. And the average day sales is simply total sales divided by 365 days. That's the average day sales. Okay, so let's see what it is for this company. Equals accounts receivable. What's our accounts receivable balance at the beginning of 2019? Oh, we don't have it. We only have the accounts receivable balance for the end of 2019. So we can't do this. We just only can use 2020 as our average turnover sales or average collection sales because we don't have the beginning balance of 2000, the ending balance of 2018. So we go back to our statement, get rid of that. So we can't do 2019. So let's just do that as a not available NA. And let's do 2020. What's our beginning receivable balance for 2020? All right, that's the accounts receivable balance at the end of 2019. Divide that by our total revenue, which is in 2020 was $7,035,600. So if we take the beginning accounts receivable balance and divide it by our average sales, why don't we do the average sales? Average sales is our sales for 2020 divided by 365 days. Oops. Why don't we just make this a little bit easier for us to figure out? Equals our total sales in year one was in 2020, 70,35,600. So let's just do that. 735,600 divided by 365 days. That's our average day sales, which is roughly $19,276 a day. So now we take this number equals our accounts receivable balance from our balance sheet at the end of 2019, 632,160. 632,160 and divide that by the 19,275, 62, and we get roughly 33 days on average to collect our receivables. That's a little bit high. It should be about 30 days. Most invoices say 30 days. So the industry average is 28 days. So it's taking us a little dot longer, like 3 extra days, 4 extra days, 5 extra days to collect our receivables. Thus, that explains why kind of we have a high receivable balance. We're not very efficient there. We need to lower that number. We need to collect our money a little bit faster. So these are all key indicators that you need to be aware of about a company. Not only how to calculate them and where to find them in the financial statements, but also what do they mean? Liquidity, debt management, profitability, market value, efficiency. These all tell us specific things about how the company is being run. I like to call financial statement analysis looking under the hood of a company. You know, the balance sheet and the income statement and even the cash flow statement show us how nice and neat, hopefully, the company looks. It's the exterior, the paint job on a car, the upholstery. The car looks nice because the financials look nice. But open up the hood, take a look at the engine. That's what financial statement analysis is about. It's looking at the nitty-gritty of the key areas of the company and comparing it to the industry or comparing it to your competitors, or comparing it to the past. What type of trends is your company doing? Is our debt going up or down over a period of years? It tells investors and tells you, the management, what are the trends of liquidity, debt management, profitability, market value, efficiency in your company. It tells about the quality of how the business is being run. So chapters 3 and 4 are not only looking at what the accountants tell us about the operations of the business, but also how the business is being run by these key financial analytical data. And these are defined in chapter 4, and they're highlighted on pages 104 and 105 of the text. As I said earlier, your assignment next week will ask you to take a look at a financial statement and find these things, and also find some of these things in a company that you select from your portfolio. So that's why it's important for everybody to get their portfolios wrapped up and cleaned up and submitted this week, because you're going to start working on them in assignments next week. So in week 2 of your online Blackboard file folder, you'll see this spreadsheet, which we just looked at, defining and analyzing Reggie Dunlop Incorporated financial statements. Make sure you are aware of what that procedure is, what it means, what financial statements are, what they tell you, how to analyze and interpret them. That's your study from chapters 3 and 4 this week in week number 2. Well, that's our video lecture for this week. Next week, you have your first graded assignment, which we posted on Monday. I will talk about that in my introduction video to you on Sunday prior to week number 3. That assignment number 1 will be on chapters 1 through 4. Look forward to meeting you all on this week on our professor meetings, if I have not already done so. Excuse me, next week on our professor meeting. So please sign up and we'll talk about that next week. And that'll be a good time in those professor meetings if you have any questions about that week's assignment once you see it on Monday. So thanks everybody. We'll talk to you soon. Have a great rest of the week. Adios.